Hi, my name is Nat Koch. I am preparing this video for linking it to this post on the Warp Investor blog. The title of the post is The Looming Trap for American Banks, Why Financial Stability Demands Fed Intervention. And the problem that is discussed in this post is really clearly shown on this graph. So here in this graph, you have the blue line is what's called the yield curve, the 10-year minus 3-month Treasury interest rate. And when it is above zero, it is said that the yield curve is uninverted. So, and the green line is the Fed funds effective rate, which is very close to the rate at the short end of the yield curve. So when you have a period like this, where the yield curve is uninverted, so it's above zero, it's uninverted, and you have the Fed funds rate very low, what ends up happening is that banks, which have to invest in safe investments such as treasuries, they tend to focus on the high end, long end of the curve. And at the long end of the curve, you're going to have what will happen there is that if the interest rates at the long end of the curve are higher, the value of those securities will be lower, will go down, because the value of the security is inversely related with the interest rate. So a high interest rate means that the value of the security goes down. And if the value of the security goes down at the long end, and you're holding several of those and you need to sell them to fulfill your obligations to your customers, the customers of the bank, then you'd have problems because you would not have the original value that you invested. So you're going to lose significant amounts of money. And since banks are usually leveraged, very leveraged, they would have problems if customers that have large amounts of money with them withdraw their balances all at once and very quickly. And this happened recently with some banks, Silicon Valley Bank, for example, which led to bank bankruptcies and serious problems for the banks. And so a period like this of sustained low Fed funds effective rates and an uninverted yield curve leads to problems, especially when the interest rates fall down again. So as Fed funds rate go up, then investing in the short term or the short end of the curve is profitable for banks, and the risk is minimal because it's short term, so they can get their money soon after or back very quickly. Whereas when it goes down again, as it happened here because of the COVID recession, then you have issues, and that forces places banks in a difficult situation. So let's see this next graph. This is unrealized losses by banks. So as you can see, this is the looming trap. As we can see here, this severity of unrealized losses by banks and this is a graph from the FDIC, it has never been in recent history, historically, is really high. So, and how does this get resolved? Well, the Federal Reserve, to maintain financial stability, would have to buy treasuries at the long end of the curve, which is why I talked about this. Consider this discussion as more of a data analysis, data-driven discussion about finance. This is not financial advice, but I did talk in a previous post about the hidden power of capital gains in U.S. Treasury investments, and this is at the long end of the scale, which one can invest in by not even buying the treasuries directly, by buying funds like the VGLT from Vanguard and also the TLT. VGLT is less expensive. So this is what I had prepared for today. Thank you for watching.